Hey, welcome to my channel. So tonight I want to talk about some random topics. Well, it's Thursday and the time is flying by and I want to do a lot of things, but I can't because I gotta do some research tonight. Tax research for a client. And the client is worth over $50 million. So, what would I do for this client as far as tax strategies? Well, first I gotta understand what motivates this client, what drives them, what their desires are, right? So, for example, they might be very charitable. So, in that note, they can explore options of CRTs and CLTs, which are charitable remainder trusts, and then you can dive a bit deeper, which leads to your charitable remainder annuity trust or unit trust. And with those, the annuity trust is actually a consistent payment every year, and that's going to be a fixed amount versus your unit trust, which is valuation beginning a year for the value of the assets multiplied by the percentage for the year, and then paid the last day of the year. So those are your pretty standard CRTs and CLTs, and usually you will stack that with a ILIT, which is a irrevocable living insurance trust. So, and by the way, all of this is just for information purposes. This is not advice, tax advice, legal advice, or any kind of advice. This is just information. I'm just dropping out here because, hey, what other time is better than today to talk about tax planning, tax strategy, private wealth management for a client north of $50 million. So how does that work? So what that does is with the CRT, with the charitable remainder trust, what you do is you can either contribute cash into the trust, or you can, obviously the trust is a charitable organization that qualifies for the exemption status. And so what you do is, or what you can do is, you can put money, straight cash in there, which for the most part, depending on the timing, that's why I said depending on the timing. But for the most part, I see where the value is going to be created is if you have an appreciated asset that has a huge appreciation piece to it. And if you were to sell it, you'll be taxed on the capital gains or the overall gains on top of your costs. And then that could be a huge chunk. So what you do is you move that, you donate that to a CRT. And so once you put it into the CRT, the charitable organization, can actually now liquidate it. And all of those gains that you would have paid on as far as capital gains, now the charitable organization, they wouldn't have to pay on those gains because they're exempt. So that's the first piece. And so once they liquidate that, now they can reinvest that into other investments. And then from there, depending on the performance and depending if you set it up as a annuity or a unit trust, then your payment, your cash flow payment would be either consistent or fluctuates. So what's the benefit of it? Well, the benefit of it is, one, you're a given person and you want to help society. Second benefit of it is you're going to get a charitable deduction, and to calculate that, you got to understand how much these cash flows are for a period in time that cannot exceed 20 years. And depending on how you structure it, I believe that the unit trust, the return has to be 5% up to 50% return on the valuation. And on top of that, there's a stipulation that the remaining value should be no less than 10%. And how does that 10% work? You pay for the ticket before you get to the train. You don't pay for the ticket as you get off the train when you start that trust. So technically, in theory, say 100 grand, it should have at least a value of 10,000. And then again, you need to check, I think it's section 7520, that's going to give you the IRS rates, and that's what you're going to use to discount the money or the annuity, the present, to get the present value of the flow of annuities over the period, whether it be 1 year, 10 years, 15 years, up to 20 years, but no more than 20 years. Second benefit is to get that charitable deduction. And then keep in mind that that's going to be, there's limitations to that. So if it's a cash donation, in this case, we're doing a piece of something, an asset that appreciated. So you would have that the gap of, I believe, 30% of AGI. So even after doing all the calculation, you might have like $500,000 or $600,000 deduction. But if you're making like 100 grand, then, and say your AGI is like 100 grand, your AGI is actually 100 grand. 30% of that would be 30,000. But numbers can carry forward for like up to 5 years to exhaust that benefit. So that's the second piece. Third piece is all right, so you got the gist of it. Pretty much, if you have a lot of you have an asset that has a lot of appreciation on it, you can consider a CRT. Because right now I'm toast. I can totally break all this down for you, but I'm tired and I gotta go do some planning. But I think this is a fun video. If you want to move wealth, even at $1 million appreciation, and you say, for example, do I believe a 2.2 over a 5-year, 100K per year annuity, that should leave you with a charitable deduction about 530,000. And so that would then be, for the true value to be calculated on that charitable deduction, you're going to need to analyze your tax bracket, and then from there that will get you the true dollar value of the benefit on doing a CRT. So what happens is, say that $100,000 is distributed over 5 years, 100 over 5 years. Then after that 5 years, the other 500 of the million would now transfer over to the organization, the charitable organization. And then that's that. And so they would not be taxed. The charitable organization, if say that 500 or that $1 million total went up to like 2 million, when they get rid of it, that is essentially tax free. So it's quite interesting. But when people set this up, it's more of like a steady stream of income. So if you look at it and say you have $1 million in an asset and your cost basis is say 300, you have $700,000 of taxable gain, right? So if you were to sell that, you say if you're making that kind of money, let's say 20%, right? So 700 times 20%, that's $140,000 in taxes. So now what do? You put that into a CRT, liquidate it, set up these annuity stream, and then from there you actually can time your installation or your distribution or your receipt of the actual cash flow. So with that timing difference, each year you can do tax planning so that future years your income is a lot lower, so then your effective tax rate is going to be a lot lower, right? So that's another strategy. And ILIT, pretty much the cash flow that you're getting, you would use that money, and then from there you would use that money to buy a policy, a life insurance policy, but it's going to be inside of a trust. That life insurance is going to be in a trust vehicle. And then ultimately, when you pass, when you leave this world and move on, then that insurance payout should go into that trust. And then that trust has its stipulations where that money needs to go. And at the same time, with that life insurance going into a trust, it's going to shield your estate from valuation, meaning that payout on the insurance policy won't increase your estate, hence more taxes, at least under the current laws. But again, all of this is information. I hope this is informative and in some way give you some clarity. I know it's not the IRC so crisp and so clear, but This is layman's term that's stretched out. But anyways, I hope this helps, and I just wanted to release some kind of content. But this is a very powerful tool. All jokes aside, very, very powerful tool. This is what the wealthy use to move assets around. And when planned properly, it's a very strong strategy to move generational wealth through the generations. Well, on that note, I hope everyone has a good night, and hit that like, that subscribe, and leave some comments if you have any questions on this or any other topics, because I can definitely be very informative, because I don't give advice on this channel, just information. Just my ideas, my thoughts, that's it. Simple, nothing complicated. All right, until next time, have a good time.